So I just want to start by where we are in terms of the audit approach. So right now what we're covering and what we covered last week was the planning, the audit planning process. And so the key things that we talked about, client acceptance and audit planning, and a part of that, once you've accepted your client, but even as you're going through determining whether or not you want to accept a client, you have to gain an understanding of the client's business and their industry. So what type of business they're in, what industry they're in, are they involved in very complex transactions? How do they recognize revenue? Is it a complex revenue recognition process, or is it a pretty simple revenue recognition process where you ship goods to a customer, when you ship the goods to the customer, you recognize the revenue? The importance of that is to be able to assess the client's business risk. Because what you want to understand as an auditor is how that risk might manifest itself in the financial statements. So for example, if a client is the type of client where they're in a very competitive industry, they're a publicly held company, they're followed by analysts, what risk do they have if they don't meet analyst forecasts? And then given the corporate culture or the tone that the company sets or management sets for the company, how's that likely to lead to, for example, earnings management? Right? So you want to understand are they in an industry where, as I said, it's competitive and they have products that are coming off patent? What happens then? Because you expect to see that if the product is coming off patent or is off patent, they might lose. You might see revenue go down. So being able to assess where their risks are, so an auditor can understand where those risks might manifest in the financial statements. The other aspect of planning that we'll talk about today, this week, is the analytical procedures. The analytical procedures at this point in time is required by the standards. They have to perform analytical procedures, and they're meant to direct the auditor's attention to where there might be problems. So analytical procedures in the planning stage is very much attention directed. The other area where you have to perform analytical procedures is during the completion phase of the audit. And in that phase of the audit is after you've collected your audit evidence, is to take a step back and say, does it make sense? Do these relationships make sense, given the evidence that I've collected? What we're going to talk about more today is materiality and the audit risk model, which consists of the audit risk, inherent risk, control risk, and then detection risk. So understanding what factors impact the auditor's assessment of inherent risk and control risk, and then how that assessment drives their detection risk, nature, timing, and extent of audit procedures, given the audit risk that the auditor has set. So as I indicated, the key things that we're looking at when we're trying to gather an understanding of the client's business is what kind of industry it is. Because some industries are going to be more complex than others. Some industries have very specific accounting standards that are, that they follow. And also some industries might be very competitive. There might be a constriction of the companies in the industry. So it's gathering an understanding about knowing what industry they operate in. For example, if you're doing performing analytical procedures such as ratio analysis, one of the things that you do would be to compare the client's results to what's happening in the industry. Right? If there's any evidence that the client might be lagging or there might be a potential issue. You also want to know what's going on in the external environment, what's happening in the economy, and how does that affect the client. Right? So you can imagine that if you have a client that's in a retail industry, that industry is probably going to be very tied to the economics of the current economic situation. So you expect to see the client impacted by the economy. The other thing that we want to look at is understand what the business operations are and what the various processes are. And so you might have clients where their business operations are very complex. Right? So that creates more complexity in the financial reporting system. And understanding what the key processes are as well. Financial, so you obviously have the revenue cycle, acquisition and disbursement cycle. If it's a shipping company, the financing cycle may or may not be as significant. Or if it's when you have a manufacturing company where they have manufacturing businesses and they manufacture all of their goods, then the manufacturing process, the conversion process, the inventory conversion process is going to play a much larger role. So those are all key. So that is going to inform the auditor about where the risks are and how they establish the audit team, the audit engagement. Management and governance, really important, right? Because management sets the tone for the company, right? So if it's a publicly held company, the expectation is, the requirement is that they have an audit committee that meets the guidelines set forth by the regulators, right? So they have to have an independent, the audit committee has to be independent. They have to have somebody on the audit committee with financial expertise. The audit committee has to meet a certain number of times, right? So that's important. Also, the importance of the audit committee is that the audit committee in publicly held companies are responsible for hiring and firing the auditors. They're responsible for the oversight of the audit process as well as the financial reporting process. So it's important for the auditor to know what kind of corporate governance exists in that organization, what the skill sets are, how corporate governance is structured in the organization. Then also understanding the objectives and the strategies of the company, because this is going to give you some indication of business risk. If a company is not meeting their objectives, that might create greater business risk for them, which then again has the potential of having a negative impact on the financials. And then what types of measurement and performance structure does the company have in place? How do they measure it? How do they evaluate it? And what response do they have to meeting or not meeting their goals and objectives? So the key thing here, in terms of understanding the client business, remember that the second standard of fieldwork, we're talking about general accepted auditing standards, talks about the sufficient understanding of the entity. Right? That's important. That is one of the requirements under the general standards of fieldwork. As I said, assessing the client business risk is being able to understand, is the client meeting its objectives? Right? And if they're not meeting their objectives, then what are the risks, and how could that risk then show up in the financial statements? Key things to remember is that management has to certify that it's designed effective internal controls to ensure that they know what business risks are, that they know what their business risks are, that they identify their business risks. It's not the auditor's responsibility to do that, it's management's. And then management also has to certify that it's informed the auditor as well as the audit committee of any significant deficiencies in internal controls. So this is new under SOX. And so again, it's for publicly held companies. Right? The auditor's primary concern is that they want to be able to identify if there are any material misstatements in the client's financial statements. That's their key concern, because if you remember, auditors issue an audit opinion, and what that audit opinion says in part is that the financial statements are free of material misstatements. So that's the objective that auditors have in auditing the client's financial statements. So I want to talk more about this concept of materiality and what we mean by audit risk assessment, what the auditors actually, how the audit risk assessment process drives the audit process. So as you recall, the financial statements, auditors have to determine whether or not there are material misstatements in the financial statements. So how do they go about determining it? How do they decide on what's material? What do you think? What's material to you? What would you consider material? So any information, no dollar value. Is there dollar value?
Like whatever it would make me change my mind.
So it doesn't matter if it's $100. If you said any information, right? So any information suggests qualitative as well as quantitative, right?
If it's enough or make me change my mind.
Well, what's enough to make you change your mind?
Things measure its scale, so the business is worth like $100 million and probably take about $10 million.
So you would measure it on a scale. Casey is going to look at both quantitative and qualitative. What about the scale? Anybody else? A number? Anybody have a number in mind? You're about to make an investment.
A penny.
A penny.
Because I'm broke.
And a penny can buy you what?
I don't know, but if
But
I can
it's your
gather
penny.
a couple
It's
of
your
pennies
penny
here and
and you
there,
want
yeah, yup, my penny.
Okay, so it's a penny on a scale, qualitative and quantitative. Anybody going for more than a penny? That's on the scale, right? You would evaluate that difference in terms of, right, so on a scale. So no one has then except the penny, right, a hard number in mind.
I mean, it just depends on where the money, whether the statement is, like, if it's not saying it's supplies, supplies in a sense, not important.
Okay, so it depends on where the misstatement is. That's qualitative, right? That's qualitative information. It's not a dollar amount. So the objective of my question is that we're sitting in this class, and some of you obviously don't have a materiality threshold. You didn't say anything. So the point is, that's what the auditor deals with. So let's multiply this class by 1 million, right? The number of people, the people who have access or use audited financial statements, the auditor has to somehow come up with some metric to be able to say this would change if this is the type of misstatement, the value, the dollar amount, the type of misstatement that could change a reasonable user opinion about the financial statement. It could influence their decision. So that's what the auditor is charged with doing, trying to come up with that number. So, knowledge check. So how many people think A? B? C? One C, one B, D. Okay. The correct answer is D. So let's talk about why it's not B and C. Right? Materiality depends on the nature of the transaction rather than the dollar amount of the transaction. Materiality does depend not solely on the dollar amount, but it also depends the qualitative aspects of that materiality of that misstatement. So let's say, for example, it's a fraudulent transaction, then it becomes material. So it's not rather than. You have to consider both. You'll also find out that materiality is not determined by reference to AICPA guidelines. Materiality is very much professional judgment. So yes, the auditor, their standards will talk about things you should consider, but you don't have to. Right? It's not if an auditor uses their judgment and say, well, these criteria that the standards suggest don't really fit my client, doesn't really fit that situation. Here's why I think this is the materiality threshold, right? And it has to be based on sound professional judgment. Right? So the correct answer here is D. The reason that materiality is so important, and probably one of the more complex judgments that an auditor has to make, is for the simple reason that when I ask questions around the room about what's your materiality, the auditor has to consider and take all of that into account when they are coming up with what's material or analyzing a transaction to determine whether or not that transaction is material. They basically have to use their judgment and try to determine, well, what would have a material effect, a significant effect on the decision of the user, right? So you can have, just based on going around the consensus in this room for the few people who responded to the question, you might not come up with the same number, right? You might look at a transaction and say, oh, that's material. It's a penny. Now, I have to say, in the court of law, that would not hold up.
It's like $20 or something, right, to bring it to court? Or
I think
something?
most courts would say that's no reason.
I think it's like $20 minimum to bring an issue to court or something like that. Or did they update that? Something like very
Well,
small.
I don't know if that would hold in. Yeah. I don't think that would hold in a business audit fail, right? It's usually larger numbers than that. First of all, if an audit firm, if somebody brought, because we know we're in the United States, so we can bring plenty of frivolous cases, but if someone brought a case against an auditor for negligence and because they lost $20, the auditors would probably just pay it, right? Because the cost of going to court is much higher. I can guarantee you they're not paying they're paying their attorneys way more than $20 an hour. So, but again, the point is, people feel that way, right? You as a user of the financial statements, if you maybe that was your last $20 that you invested in this company and now it's gone, right? So you will feel, upset about that and you will want restitution. But usually the auditor has the $20, it's not going to be they wouldn't consider $20 to be significant. It is going to be based on other information, right? So we'll talk about that in a moment. So the auditor is going to make an assessment. So during the planning stages, what the auditor is doing is making an assessment about the tolerable misstatement in the client's financial statement. What are we willing to tolerate? And that's really based on what the auditor considers would influence the decision of a reasonable user. Okay? And we'll see some benchmarks in a moment. So that's called your planning materiality, what that quantitative number that you allocate. And anything above that number, a misstatement above that number, the auditor would conclude that has the ability to influence the user of the financial statements, influence their decision. Right? So usually in that situation, an auditor generally is going to insist that the client book that adjustment. It's not just in the planning stage. We set the tolerable misstatement in the planning stage, but you're always assessing materiality as you gather evidence. So as you go through field work, final stages of the audit, if evidence comes to light that suggests that there could be a material misstatement, the auditor is going to evaluate it each day. The planning materiality is just the initial quantitative benchmark. And the materiality will have an impact on the amount of work and the extent of work you do. So I already talked about the fact that what is it? It is what influences the economic decision of users, taking on the basis of the financial statements. It's going to depend on both quantitative and qualitative factors. So it makes it a very complex judgment, and the quantitative factors that auditors can consider, and this is just some suggestions. Firms will have something similar to this. They will have their own benchmarks and guidelines that they provide their auditors to use when assessing materiality. The auditor has to document and justify why they choose the basis that they use. So when we talk about materiality, we have to consider it not only from the quantitative perspective, but also from the qualitative perspective. So the quantitative perspective is the benchmark that we use to set planning materiality, to determine materiality. So what would be the reason to choose one of these and not the other? What would be your consideration? What do you think some of the considerations that auditors would have in deciding on what to choose, which benchmark to use?
Which factor you're saying?
Yeah, so let's say an auditor decides to choose a 3-year average over income before taxes.
It would depend on which
this is the planning, right? So we're gonna use one of these to set the planning number. Then we'll allocate it. This is right now the planning. So this is the benchmark. I want to say an error or a combination of errors that is greater than some benchmark is considered material. Why might the auditor use a 3-year average versus income from operations? What's the difference? Why would it matter? Is it the same? What if I had a startup company? What if I had a startup company and I had a very mature company? And I'm the auditor for both companies and I'm setting materiality, the benchmark. Why would I use something different and why?
If I have a very mature company, the front is 3-year average. That's not what you have established history. Whereas if I have a startup company, or I could use
Okay, so that would be your case. If he had a startup company, he would use a mature company, he would use a 3-year average. And if it was a new company, he would use total, you said total, income before operations, or income before taxes. Anybody else? Everybody agree with that? Disagree?
I might agree because start with the volatile in the beginning and have major losses in the morning.
So then that would argue against what you just described. Right? Because if you're saying, your argument is that it's volatile. So 1 year you can have income, 1 year you could have a loss. So why would you use 1 year? Right? Because that 1 year is not reflected.
But if you use average
Then you're taking into account the fact that there's movement. There's up and down, right? So you average it out.
but what if it's the first year of $20 million?
But you're taking an average, right? That would be the point to take the average, is because there's volatility. And so you want to smooth out the volatility. Right? So you want to get a number, because then then you can say, well, why not? Then you're being more arbitrary, right? By taking up 1 year that has income. So usually if you see fluctuations, and the auditor might take the rolling average, right? A 3-year average, a 2-year average, a 4-year average, because it is a startup company. They haven't started a pattern. Or you might say it's a startup company, and because there's volatility in income, maybe we should look at something that's more stable, like total assets. Maybe. I'm just saying, I'm just throwing out. That's the judgment part of materiality. That's the thought process that an auditor has to go through in terms of deciding, well, what should the benchmark be? And justify the rationale. And maybe the auditor does decide to use that. But I could come in, you see how we have different approaches to that, right? And say that, well, maybe it makes more sense to look at something other than income. So those are the types of considerations an auditor would have to take in. If you have a stable company, right, if their income is stable over the 3 years, then you really don't need, because your income is showing the same thing, so you really don't need a 3-year average. Maybe you just look at income before operations because they have stable income, right? Their income is not fluctuating wildly. So maybe in that case, if it's a mature company with income that's pretty stable over a period of time, then you might use income from before taxes. But again, the point is, the auditor has to be able to document why they're. So that's why, remember we talked about earlier, understanding the business, understanding the industry, the economy, external factors that impact the company. Because all of these things are going to play into or contribute to the auditor's judgment around things like setting materiality and the audit risk assessment. So that's totally the judgment part. The quantitative say you should start with a benchmark, right? To set planning materiality or your tolerable misstatement. And again, the percentage that the auditor applies is based on their judgment, whether it's 3 to 5%, the audit firm might have they might have very strict rules or very defined rules. They might say that if it's a startup company and these are the characteristics that the company displays, then we should use, to determine materiality, we should use total assets and document otherwise, if you have to document otherwise. Then we should use 5% or 3% or 2%. The audit firm will provide guidance. So that establishes your benchmark, your planning materiality. Now, as you go through the auditing, right, you're going to come across adjustments that have to be made. And the auditor has to evaluate those adjustments on some qualitative metrics as well. They have to consider, for example, was this adjustment related to fraud? So remember the case that we did, the professional skepticism case. Will found in his testing discrepancies. And I think the discrepancies, if I remember correctly, amounted to about $300. And their planning materiality was $5,000. So clearly, that's immaterial. Most people would say that's immaterial, $300. But it wasn't immaterial. Why wasn't it immaterial? Why did Will move forward? This is the professional skepticism case.
Because it seemed like fraud, right?
Right. Because it was fraud. It was fraudulent activity. And when there's fraudulent activity, that's not immaterial. That's considered material. So that's a quality. Even though the dollar amount was immaterial, the factors surrounding that misstatement, that led to that misstatement, was considered material because it was fraudulent, potential fraudulent activity. So that's what we mean by qualitative factors that auditors consider. Another thing, and these are just some bench guidelines. They're not, again, this would be based on auditor judgment. The auditor has to evaluate the nature of that misstatement, the transaction resulting in that misstatement. Other things you might consider would be if the company is close to missing a debt covenant. Are you familiar with debt covenants? So debt covenants are terms that a lender would put in a loan agreement that the person borrowing, in this case, let's say that the client is borrowing from a bank. The bank might have certain criteria that that client has to meet on an annual basis in order for them to continue the financing. Right? They could call them, if the client misses that covenant, then the bank has the ability to recall the loan, meaning that the client would have to pay the loan right away. So debt covenants their auditors will monitor any debt covenants to ensure, to determine whether or not the client has violated the debt covenant or is close to violating the debt covenant. So if you have an adjustment, and booking that adjustment would cause the client to violate a debt covenant, then that is material error. It becomes material, even though it might be quantitatively immaterial. Make sense? And so those are the factors that the auditor has to consider. Not only quantitative, the quantitative is what we use to set the benchmark or tolerable materiality level. And then we evaluate transactions, the nature of those transactions, or qualitative factors. Yes?
For like a debt covenant, when you're close to violating it, is that based off like financial ratios or something?
Right, so let's say, so a debt covenant might say that you have to maintain a current ratio of some predetermined number. And if the company is, when you calculate that ratio, if you are below that predetermined number, then they violated the debt covenant. Now, in most cases, in some cases, what will happen is that a company knows when they're going to be close to violating the debt covenant, right? So they will go and try to get permission from the bank to wait for, at least for that reporting period, so that it doesn't create, they're not put in a position where their loan is going to be recalled. They will notify the bank and try to work that out with the bank ahead of time. But one of the things that auditors have to be mindful of is, I'm sure if you talked about earnings management in your other classes, but as I said before, that there's enough subjectivity in certain accounting standards that allow management to kind of push the boundaries or report more aggressively. So they exploit the subjectivity and gap to do that. Debt covenants is, companies, because companies are interested in managing to, for example, earnings forecasts. They're very fixated on it. And so there's been shown that they manage to that number. They want to make that number at all costs. Well, they also don't want to violate debt covenants. So auditors, they look at things like in terms of inherent risk factors. They look at whether or not the company is close to violating debt covenants, whether or not the company is close to not meeting analyst forecasts, because that creates higher incentives for management to possibly to manage earnings. And so that's an inherent risk factor, which we'll talk about in a review, that auditors consider. So those are the kinds of things that they look at. But these are just some examples of qualitative factors that auditors would consider that would, if any of these qualitative factors exist, then that would make a quantitatively immaterial adjustment or, error become material. So let's look at an example. So number one, is it material? What do you think? Yes, no? How would you evaluate whether it's material or not? What would be the first thing that you would do?
I mean, it says that they fought a lengthy battle. I mean, that has to be material. Why would somebody invest that much time or money to fight in something that's immaterial to them?
Okay, so you would evaluate that they fought it and say, but at this point we're saying they fought they claim a little loss of $10,000. So you think it's material because this was a lengthy battle? Okay.
I don't think it's not.
So you're saying a quantitative. Anybody else? Okay, so in this case, right, the fact that a company wages, the fact that a company, it is not material, right, because it's a $10 million company. The fact that they have to report an extraordinary loss of $10,000 is not going to influence the user, right? So they would just, it's what they fought, so that they probably can get, the reason you fight is you try to get the, try to reduce the loss as much as possible. Okay, so they were probably trying to get the insurance company to cover more of the loss so that they could cover more or reimburse them for more so that they're able to only report a $10,000 loss. They were trying to reduce the loss as much as they can. So $10,000 on a $10 million net income. So the company has $10 million net income, they probably got a significant assets. So that would probably not be material. But what about number two then?
Material because of this 20% is actually some serious impact.
Right. Yeah, I guess in additional cases, you have to look at two scenarios. So the first one, like you said, is $10 million net income. So you can assume they have a lot of assets. However, they're going to $50,000 in net income. They might be in some like a big assumption where you assume they don't have as much at all. So that one building could be valued as a big percentage of the assets too.
That's what's possible. Right. But if you just, right, so if you look at anything, right, it's rare that you're going to see, usually you're going to see the percentages within this 3 to 5%, but that clearly 20% of net income is going to be considered a big loss. That's going to be, so quantitatively, just without even considering any qualitative factors, is going to be considered a significant loss. So it would be considered material. So what's the approach that the auditors use? You set your materiality thresholds during the planning stage of the audit. Because you have to set it through the planning stage of the audit, because you have to have a basis to evaluate, at least quantitatively, a quantitative basis to evaluate any errors or misstatements that you uncover through the audit process. Then what you're trying to determine, again, is that what is it? What's that benchmark, that threshold that will not affect users' decisions? So anything below this amount will not affect the user's decisions. And then you take that, right, based on that. So let's just say you determine that it's materiality, the quantitative materiality is going to be based on some percentage of net income before taxes. Whatever that calculation is, then that's your tolerable misstatement. So if you say it's 3% of net of income before operations, whatever the number is, that becomes your tolerable misstatement. And as long as the financial statements do not exceed do not contain errors that exceed this amount, then you would conclude that the statements are fairly stated. This tolerable misstatement is then allocated to different accounts in the balance sheet. Okay? So most, you'll see, as I said, it's mostly allocated to the balance sheet. If you think about it, most transactions that go to the income statement end up on the balance sheet. So it has a balance sheet effect, I should say. So you would allocate that amount. So let's say you came out with 50,000 as a materiality limit threshold. You would allocate that 50,000 to accounts receivable, inventory, payments, for example. And so you will allocate it, and that again is based on the auditor's judgment. What percentage is allocated to inventory versus what percentage is allocated to accounts receivable. And that'll be tied into risk. So what's going to drive the auditor's decision about what accounts and how much to allocate is also going to be the riskiness of the account, like how susceptible is the account to misstatements. So for example, if you have, you have accounts like property, plant, equipment where there's not a lot of activity, it's pretty stable. You know that the inflows and the outflows is because of conditions and deletions and changes in cumulative depreciation. Then you might consider that a low risk account, and you might not allocate as much. Allocate that significant materiality amounts. So you would allocate it to the other accounts in the balance sheet. So again, that's based on the auditor's judgment and their assessment of the risk for each balance sheet account. So what the auditor is going to do once they allocate that, the reason for establishing materiality is because you have to evaluate misstatements. And we'll get into this more, but there are two types of misstatements that the auditors deal with. One will be likely misstatements, and the other will be known misstatements. So known misstatements are easy to identify, right? Because a known misstatement is something that there's no guesstimate around it. They're known. For example, if we took revenue and we said that the company recognizes revenue when they ship goods to a customer. So if the auditor is performing a cutoff test, and performing that test, they find 10 transactions that amounted to $75,000 that should have been recorded after year end, but instead those transactions were recorded as of year end. So they're recorded in the wrong period, basically. That's a known misstatement. There's no guessing about it. The items didn't ship before year end. So because they didn't ship before year end, you can't recognize the revenue. That's a known misstatement. Whereas a likely misstatement is differences that might be because the auditor's judgment is different from the client's judgment. So let's take the allowance for doubtful accounts. The auditors, the client gives the auditors their calculations for the bad debt expense for the current period. The auditors perform their own calculations and determine that the client's calculation is understated by $75,000. Well, that's a likely mistake because you don't know. It's not. It's a judgment, right? The nature of the allowance for doubtful accounts is a judgment. So you don't know that there's going to be $75,000 worth of bad debt expense here. It's a likely judgment. Another example of a likely judgment is sampling. We perform sampling. We take a sample of transactions, right? And then let's say that the client had 100,000 transactions. The auditor looked at 10% of those transactions, or 1% of those transactions, and they found some errors. They have to take those errors. Let's say those errors on 1% of the transaction amount to, 2%. They have to project that 2% to the entire population. So if they take that 2%, apply to the 100,000 transactions, and come up with a potential mistake, a likely mistake. Again, it's based on judgment and extrapolation. So it's not a definitive number in the sense that you could point to, documentation to show that these errors did occur. Right? That's the auditor's estimate of what the misstatement is. But in any event, however the misstatement is determined, the auditor is going to evaluate those misstatements in relation to the materiality threshold. If it's above, then the auditor, it will require the client to make the adjustment. Because if the client doesn't make the adjustment, then the financial statement, you can't say that they're not free of material misstatements. Questions? All right, so let's talk about risk. As I said before, the audit approach is a risk-based approach. So when I talk about risk, I'm going to focus more, my focus will tend to be on the standards, the PCAOB standard, because I'm coming from the perspective of publicly held companies. So the PCAOB has several standards dealing with risk. So AS number 8, auditing standard number 8, PCAOB standard, says that the auditor's objective is to conduct the financial statements in a way that reduces audit risk to a low level. What is audit risk? How would you define audit risk? Well, that's the audit risk model. Were you going to say something else?
Yeah, and that would give the ground opinion.
That's your risk. Think of the audit risk as a blown opinion. In other words, the auditor gives an unqualified AS number 12 says that there's standards on how auditors should assess that risk. So AS 12 deals with how can auditors make more effective risk assessments in order to ensure that they conduct an audit so that this is relatively low. And AS 13 deals with, AS 13 deals with response to that risk. What kind of procedures should auditors design and perform to address the risk that they've identified? So in other words, auditors have to be, if the auditors blow this risk assessment, right, then that's going to have a negative impact on the audit and audit quality. Because if they don't assess risk correctly or effectively, I should say, if they don't assess risk effectively, or procedures to assess it effectively, they're not going to respond to that risk effectively. And as a result, they increase the chance that their audit risk won't be low. They increase their audit risk. So that's what the audit risk model does. The audit risk model presents a framework for auditors to use in assessing risk and responding to that risk, nature, timing, and extent of audit procedures. So let's talk about audits. First, we have a knowledge check. What do you think? What's the answer? D. Everybody think D? Right. The business risk is the client's risk. Auditor's risk is engagement risk. That's the auditor's risk. The risk that they face when they take on an audit engagement. The client's risk is business risk. It is the responsibility of management. Auditors just assess the client's business risk in order to determine what impact that could or might have on the financial statements. So, AS number 12 says that auditors have to perform audit risk assessment procedures in order to identify and assess the risk of material misstatements. When we look at risk, we're looking at not only company-specific factors, but also external factors. So remember, when I started the discussion, I talked about understanding the client's business, right? Understanding where the business risk of the client is. Some of those things we talk about were both internal to the client. Some of the things that we talk about were internal to the client and external, such as industry, such as the external environment, the economy. So the auditors examine all of those types of factors and examine them and assess them in the context of the impact on the client. If the auditors do not assess risk appropriately, as I said, that has a spiraling effect on audit quality, right? Because they're not going to adjust their audit procedures appropriately to deal with that risk. So the risk assessment process is extremely important, and it's also very complex. The relationship between materiality and risk is that the higher the audit risk, the lower the materiality level assessed by the auditor. Why is that? Why do you think that is? Why is there an inverse relationship between audit risk and materiality level?
Because the more that you're confident that they controlled it themselves, the less you need to, I guess.
Well, the auditors, both of these, right, are the auditor's judgment, right? Audit risk is the auditor's judgment, materiality is the auditor's judgment.
So audit risk is like corporate opinion. So if there's a higher risk of that, then it's saying that the materiality level being less, it's like that you're kind of taking more risk in general. So
Well, if you lower the materiality level.
yeah, so you're not being conservative if you lower the materiality. So
Actually, you are being more conservative, right? Because the materiality, because what you're saying is that if, let's say I can set materiality that anything over 10,000 is, anything under 10,000, over 10,000 is immaterial, or I can say anything over $100,000 is immaterial, right? I'm being more conservative when I said lower, because there could be a lot more transactions, right? I'm saying that a transaction that's $10,000 is considered material versus a transaction, or a transaction is considered $100,000 is material, right? So by setting a lower materiality level, I'm being more conservative, right? I'm not willing to, because I'm going to waive anything that's below that number, right? So I'm going to say, oh, it's not material. Anything below 10,000, it's not material. So, you know, so the lower you set, so when there's higher audit risk, right? If there's higher audit risk, if I feel there's more of a chance of blowing the opinion, I want to look at more transactions, right? I'm going to be more conservative. That's what that says. That's the relationship, right? Because remember, audit risk is in relation to the auditor. That's the auditor's risk, not the client's. So the auditor wants to control their risk, right? The audit firm wants to control their risk. Regardless of that, we know that auditors are going to accept some level of risk. It's inevitable. Why? Why can we not have zero audit risk?
Because at the end of the day, that's exactly what the purchase means. You have to, you're going to take some sort, like, even if it's a minimal risk, because despite all the evidence they give you, they may find a way of covering something up. So in the end, you have to take all the evidence that they give you, make sure it corroborates with their story, and then you're going to give an opinion. But if somehow they were able to put something deep within the ground that you couldn't see, that is sort of the risk you're going to end up taking, even though it wasn't your fault to not cover it. But
Right. So they're not the auditor's financial statements. The auditor is coming in to audit the financial statements. You try to design your audit procedures to the best of your ability based on your assessment of that risk and responding to that risk. But the client, in the end, in the client's financial statements, you conduct the audit to professional care, right? If the client is colluding and they're covering things up, then you might not catch it. But you want to have sufficient and appropriate audit procedures to be able to uncover a material misstatement or error if one exists. But you're never going to be able. The other thing is, think about what I said before, there are known judgments and there are likely judgments. So we do, right now, auditors sample. They select a sample of transactions to examine. When you select a sample, even when you do a statistical sample, the problem transaction might not end up in your sample. That doesn't mean that you blew it, right? That just means that it's sampling. So there's some risk when you sample, right? Because you're not looking at 100% of the transactions. There's no way you can get down to zero audit risk. You just try to minimize it as much as possible. So that's why the risk assessment process is so important and so critical to the audit approach when we do the risk assessment. So now I'm just checking. You might recognize it. What do you think? I heard B. Everybody think B? Anybody think anything other than B? Right. B is the right answer. That's the probability that you don't want to blow the opinion. That's the auditor's risk. So that leads to the audit risk model. And I'm just going to stay on this slide and then we'll pick this up on Thursday. The audit risk model. The audit risk model is the framework that auditors use to audit the financial statements, to determine the nature, timing, and extent of the audit procedures that go into the company. So we already said the audit risk, the only thing that the auditor controls in this model is this risk, audit risk, and detection risk. That's the only thing that they control. The auditor assess inherent risk and they assess control risks. They evaluate those risks. And based on their evaluation of what we call the risk of material misstatement, which is inherent risk and control risk. So if I ask you, what are the components of risk and material misstatement, you should be able to spit it right out. It's inherent risk and control risk. Right? The risk, think about that, because the basis for that is the client controls these two things. The controls are the client's system of internal controls. The auditor doesn't develop systems of internal controls. The inherent risk factors deal with the client's environment. Right? So therefore, the auditor can only assess this, and based on their assessment of the risk of material misstatement, they're going to set their detection risk. And that's the risk that their audit procedures will not detect a material mistake. And given the audit procedures they perform, they will not detect a material mistake. They want to keep this low. So we're going to go from the perspective that audit risk, because this, think about AS number 8, the auditor should, the objective of their audit risk assessment should be to keep this low, relatively low, to keep this number, this risk low, right? So the auditor then has to say, given the risk of material misstatement, what level of risk am I willing to accept so that this risk remains low? The only two things that they can control, audit risk and detection risk. Okay, so they don't want to blow the opinion. They have to decide. That's the auditor's decision to decide how much risk they're willing to accept. So, the relationship between audit risk and detection risk is inversely related to evidence. So the lower the audit risk, if you want to keep your audit risk low, the lower your detection risk. Right? You're not, that means that you're not willing to accept a lot of risk that your audit procedures will not detect a material mistake, will not uncover a material mistake. Because you want to keep that detection risk low, then you want more evidence. Right? You're gonna gather more evidence. Because evidence gives you more information. It reduces your information assembly. Right? The more evidence, more transactions you look at, the more controls that you test, right? That gives you greater evidence about the clients, about the risk of material misstatement. All right, so we're going to go from that premise starting in a moment. So just a couple of things. When I ask you about the audit risk model, I'm not interested in you being able to calculate it. I know that in the textbook they give some quantitative amounts. I'm not really interested in whether or not you can manipulate a mathematical transaction. What I'm interested in is that you understand the relationship between the components of the audit risk model. What does the client control? What does the auditor control? How a change in any one of these components influences the other. Okay. So understanding the relationship. So I'm more interested in understanding, to critically think about this risk model and understand and be able to analyze the model. So if I give you a change in risk of material misstatement, you should be able to tell me how that impacts the auditor's audit risk or impacts detection risk. Okay, so we'll finish this up on Thursday. We'll talk about the exam on Thursday as well.